EMX Royalty employs a different strategy for its royalties than lots of other companies and have a lot more metals in the platinum group and battery metals compared to just precious metals like a lot of other royalty companies. So after reviewers suggested them, I thought I'd look into their financials. So let's get into, is EMX Royalty a buy? Hey, my name is Tucker Krause and I'm a 14-year-old investor. In today's video, I'm going to be analyzing purely the financials of EMX Royalty to determine if they are a fair buy at this point. So let's quickly get into the stock itself and what the company does. They trade under ticker symbol EMX on both the Toronto Stock Venture Exchange as well as the New York Stock Exchange, though I'm going to be focusing on the Toronto Stock Exchange due to the fact that all their finances were in Canadian, so I can much easier compare their Canadian finances to their Canadian stock. Plus, it prevents things from getting messed up in converting currencies and whatnot. They're currently trading at $4.28 Canadian per share, with a market cap of $363.778 million, and no PE since their earnings per share is negative 7 cents per share, and they have no dividend, and this is all as of close on May 11th. EMX Royalty is 17 years old, and their CEO was actually a former management member at Newmont and was a senior geologist there as well. If you want to hear about Newmont after this video, I just did a video comparing a bunch of different gold miners, including Newmont, so you can go check that out after this video. And before we continue, also make sure to smash that like button. So the reason why EMX is different is because instead of buying existing royalties and financing that mine later in pre-production and whatnot and not getting royalties till the mine is producing, EMX will then instead get prospective mineral rights and sell those to a miner who then develops the mine and explores the mine all on their own and whatnot and gets it to producing, though this often means EMX is getting paid long before production. And so essentially they make their own royalties, though they'll still occasionally buy ones they deem undervalued. And so because of this, it does kind of make up for the fact that they literally only have 3 producing assets, I believe is what I saw. It was something in that range where they have tons and tons of exploration assets. And so at least it's good to know that, okay, they're at least making money from more than just those producing mines, which is also shown in their income statement and whatnot.
So most importantly for diversification are the two on the left. Geographically, you can see they are North America heavy, though they do have quite a few assets in the Nordic countries. Though, again, I wish it would be a little bit more spread out, because once you do the Nordic countries and North America, there's very little for everything else, though they still are on 5 different continents. Commodity-wise, this actually looks pretty good. They're only roughly 2/3 in gold, which compared to lots of just the pure gold royalty companies is really good. It's great to have some of the battery metals and the platinum group metals in there. And so you can see here they have lots of very notable operators and partners such as Newmont and Rio Tinto, just to name 2 of them. So you can see they're definitely confident in their company. You can see 15.5% of their company is owned by its management. Then you can see lots of other notable investors like Sprott and Newmont. And then after that you can see they have a ton of cash on hand as well. Now here is their CAGR for their stock price over the last 5 years, and you can see EMX is substantially above lots of the other royalty companies, though to be entirely fair, EMX's market cap is still far smaller, so it's a lot easier for them to move.
Some of the growth prospects for this company include commodity prices and commodities just booming in general, but also that they'll benefit more from a possible green revolution compared to just say a pure gold royalty company, since they've got lots of the battery metals and lots of the platinum group metals. Not to mention their CEO has stated they are moving more into these battery and platinum metals and being less reliant on just gold. And even though they are paid before production, that doesn't mean that they're not going to get paid during production. And so because so many of their assets are still exploring and developing, they have just a ton of general growth potential there as well. One more thing is that they don't have any debt and have a ton of cash on hand, so they can of course continue acquiring assets because of that and all that good stuff.
So, over the last 10 years, there's been a compounded annual growth rate of negative 1.75%. Though, to be fair, if you go for 2012, since this is around when 2011, around when the last commodity boom ended, you can see since 2012, it's technically has been going up. And so, if you judge it like that, then it becomes a bit more fair. And so, especially just the last 3 years, they've been on an extremely sharp upcline. But the more important number would be earnings per share, because that lets you know if they're actually effective. And in that case, not necessarily. Though, since 2011, there's been a 13.57 increase in XLs, just weird. And then in 2018, this massive outlier is because there was a sale or purchase of a company, something along those lines. Whereas you can see in every other year, not exactly looking too great, though we can see in general it's been getting a little bit more effective since early in the 2010s it was down around 20 cents or less compared to only being around down 10 cents or so since about 2015. Now, the reason I didn't use EV to EBITDA or price to earnings ratio is due to the fact that they don't have an EBITDA or proper earnings, they only have revenue. So enterprise value to revenue, you can see I just compared them to lots of the gold royalty companies that I compared in a previous video. So make sure to go check that out if you haven't already after this video and the gold miner video. And so you can see that even here, EV to revenue, they still are substantially higher than their competition. We can see how Cisco and Sandstorm and Royal Gold are substantially better choices, at least in this scenario here. Now I used price to book because again, they don't have proper earnings. And you can see right here, again, still kind of just middle of the road. They do surpass Royal Gold, Wheaton, and Franco-Nevada, though they're still behind Sandstorm and substantially behind Cisco. Now on to just a floor value for them. We can see that that's only $1.17. You subtract their liabilities from their assets, divide by shares outstanding, and that gets you their floor value. You can see it's still trading at 266% above that, though to be fair, often the floor value is well below where they're trading at right now, just usually not by that much. Now, where it really matters, the intrinsic value, the discounted free cash flow. My intrinsic value came out to $1.82. Now, and I used discounted free cash flow for this, and you might be wondering, doesn't the company have to be profitable for that? Yes, it does. What I did in this situation was I reached out to EMX's management, and they told me they expect to go free cash flow positive by 2022. And so what I did is I averaged out the profit margins and free cash flow to profit margins of all the other gold royalty companies, since these guys are still roughly 2/3 in gold. To clarify that a little bit better, essentially what I mean is I kept growing their revenue by that same CAGR, and to assume what their free cash flow would be, I took those average net profit margins and free cash flow to net profit margins and applied them to that revenue. And so that gave me that value there, which again, that's still substantially below where they're trading right now. So just on the surface, doesn't look good for EMX in the financials.
So, of course, as more of a value investor and that discounted free cash flow intrinsic value compared to their current price, that's definitely a no-go. And plus, they're a 17-year-old company, are still barely even able to get an EBITDA in most years. And I was even looking back to like the early 2010s and whatnot to see if that was different. No, not really. Though, speaking of value investing, I did just order the Intelligent Investor and Security Analysis by Ben Graham. So I will have reviews from a beginner's perspective coming out on those soon. So make sure to subscribe if you don't want to miss out on that. But something you could definitely note that, again, why I could be missing out on something massive here is because their CEO seems to be very confident in a lot of their assets and how it's going to work out really well. But me personally, as a retail investor, I'm not about to go look through their 200 plus assets. That's not happening. And that's even in some of the Crux interviews I listened to, that they seem to bring that up. Like, hey, how are people supposed to figure out if your company's good or not? How are they supposed to analyze this? And so me personally, yeah, that I agree with that. I'm not about to do that. So basically, it seems very high risk, high reward. Personally, the financials just aren't there, so that's an avoid for me. Though if you believe that a lot of their assets are going to work out well, they could be a massive home run. So without further ado, thanks for watching. Make sure to, again, subscribe, smash that like button. I will see you next time.